Good morning and happy 4th of July to YouTube land. It's Sunday. It's time for another edition of the Bet Out of Debt Show. How are you, Mr. Patrick, before we dive into this subject matter? Oh, Patrick, hold on for a second. We're experiencing the same old stuff we experienced before. Go ahead, Patrick.
Yeah. So once again, happy 4th of July to all our lovely viewers. We appreciate your following us and learning with us. And yeah, I feel very good, actually, really good.
Yeah.
There's some exciting things that are going on in these markets, and can't wait to delve into them.
Yeah, for sure. So Patrick, without further ado, I want to go up first because let's do a comparison between
Okay.
two stocks that are pretty hot. And one is a stock that's projected to be hot over the future. One is a stock that we continue to talk about that's hot right now. So,
Okay.
so I want to pull up plug. I want to pull up a Barron's article
Mm-hmm.
on plug and kind of go into the bull case, and bull case meaning a case that we believe you should buy. So I want to go into a bull case for a plug, and then I may kind of back up a little bit on that based on looking at some of the fundamentals. And then I want you to pull up the bull case on Nvidia, and then that will allow our audience to make a reasonable decision on, even though Barron's is kind of bullish on plug, we are very bullish on Nvidia. We are both Nvidia owners. Then the audience can be the judge. So let me pull up this Barron's article here. Let's see. Let's make sure you can see the screen. Oh snap! I just deleted the Barron's article by mistake. So I'm going to have to do this live, Patrick, on Barron's. On plug. So here it is right here. So Patrick, I want to make sure that's coming through. So I'm not seeing it. I'm just seeing a blank screen for now. So let me make sure. Let me go over here and see if I can get that to come through here. Hold on for a second. And let's go Safari. And there we go. The magic of electronics. So Patrick, can you see that now?
I can see it.
Okay, perfect. Let me blow this up a bit if I can. So, those who are in the stock market know about this company, Plug, and Plug is a pretty impressive company. It 52 weeks ago it was around $7 a share. It went up to as high as $75 a share. And currently Plug is trading right around $32 a share. And
Mm-hmm.
what Plug does is they create fuel cells, and they are in the hydrogen space for conversion from fossil fuels to hydrogen fuel systems. And even in the electronic vehicle or car space, Plug is that distributor of hydrogen fuel gas pumps and things of that nature. I should say hydrogen fuel pumps to replace fossil fuels. So they're in the space of not only the gas stations or hydrogen stations, but as well as building fuel cells to power vehicles and machinery. So
Interesting.
yeah, so Barron's, a lot of people do not have a Barron's subscription because Barron's costs like over $100 and some odd dollars a year for a subscription. But I have one. This is kind of how I do some of my fundamental analysis. And I saw an interesting article here about plug. And this analyst in particular, RBC analyst Joseph Spack, he goes into detail talking about, hey, okay, plug is only $32 a share, only up approximately 1.9% for the year
Yes.
2021 so far. We're midway through the year. And he talks about how plug makes fuel cells to run on hydrogen, which generate electric, but don't produce carbon dioxide, which is the whole clean energy play. Let's go down here. Spack, this analyst, he believes that plug is a good play because with a lot of investment and government support, we believe it's a multi-decade hydrogen transition can occur. So, with the government going down clean fuels and getting rid of this whole fossil and pollution stuff, this should be backed by the government, getting grants and all of that stuff. So one could make a bullish case that plug is cheap right now, being that it's only $32 a share. So just kind of looking at the chart here, just kind of show how plug was up. It's hard to get to the peak up here, but that's at $75. This
I
is
think
not.
I saw the 75 somewhere.
Yeah,
Yeah. It's
I'll show it on bar chart, but
yes.
you can see the whole trajectory of 2020, January. And so we said 52 weeks. So 52 weeks would be from July to July, but January 2020, plug was as little as $3.82 a share. It rocketed all the way up here. See if I can get all the way up there. Oh, I think I got up there. $73.18 at the peak, and then started to work its way back down through the March sell-off, and then it's working its way back up. So a good speculation stock if you want to do a short-term spec or even a long-term play on hydrogen. SPAC, this analyst talks about, the shares of the stock went up 18 times. The shares trade about 18 times revenue right now. That would be better if it traded 18 times earnings, but this is actually times 18 times sales. But he's talking about it's only up 1% for 2021 compared to last year. It was up now 173%. He's just making a bullish buy case for a plug. And then what Barron's had in here, some additional information which I thought was interesting, going out to 2030, so going out another 9 years, and just looking at the clean hydrogen production space. So the cost to produce hydrogen from now versus 2030, that cost is going to be cut by 60%. So that's more profitability, more room for the stock to grow if one were to invest in plug. There's going to be a 291% increase in capacity of hydrogen. So the ability to have more hydrogen is projected to grow about 3 times, which is also more revenue. That means a bigger market, more sales, and that ability to make better earnings. And then a $70 billion committed public funds to support the transition. So $70 billion in public funding support. That's that government backing, right?
Yes.
So
that's very good.
That's very good. That's that free money to say $70 billion. We're gonna, over the next 9 years, the government will be supporting plug. So a very bullish case by this analyst, Mr. Spack. Let's look at what his projections are. He projects that the stock is going to be around $42 per share this year, based on 35 times the multiple on 537 million in cash flow by 2025. So he's looking at the stock to be at $42 a share this year. And some of the other analysts, 2/3 of the other analysts out there that covers this stock, they rated a buy. So there's a lot of consensus out there that Plug is a buy. And their price target for the year is even higher at $45 a share on average. So Plug is a pretty good bet if you would want to go in and just invest in a company based on this type of fundamentals. So there's a other side of Plug I wanted to point out, and let me point out the other side, that how I would evaluate this. So just looking at Plug, and let me go bar chart and let me put in Plug here. Let's do some additional analysis here on Plug. So we're gonna, let me blow this up a bit. So we are on the price overview. So it's showing that Plug is currently trading at
it's at 32.
Yeah, 32 and a half.
So it's well below the analysts.
Yeah, well below
consensus of 45.
Absolutely. And then what it shows is the 52-week range. So from July last year to July this year, the high was as high as $75, as low as $7. But here's where I started to run into some concerns. So the PE is 0, and that's because it's not earning. So it's losing over the last 12 months. It's lost 31 cents per share. Most recently, it reported on 6/22, 12 cent a share loss, and the next earnings is coming out on August the 5th. So that's some good information if you want to do a trade on Plug based on what we were just saying. So that was a little concerning for me, that the company still is not making money, but that's not unusual for, a company that has not been out there that long. Let's look at some additional things. Other things I like to look at from a fundamental perspective is, what do the analysts think of Plug? So here's the analyst analysis that you can click on bar chart. This means something. There's a moderate buy rating on Plug. So I think that's decent. And you can see the number of sell ratings versus buy ratings and where we currently are. Let's look at some of the key indicators here. Let me look at go back to the price overview. So technical chart shows a weak sell, and just looking at where Plug is on the Bollinger Band, it recently hit highs and then is working its way back down to the middle, which means if the stock is really strong, it should bounce off the middle. If the stock price is not as strong, it will hit the second deviation low, and this would potentially be a good buying opportunity. You can see here this red line shows the 200-day moving average. So Plug is trading right around the 200-day moving average over the last 3 months. But if you look at a 6-month curve and look at the 200-day moving average, the red line, Plug has been mostly trading above it, but just of recent, in the last 3 months, is straddling the 200-day moving average, which is, again, this red line that's cutting across, which means it could be a good buying opportunity right now, because traditionally Plug has been up and then the RSI shows that the stock is selling off. So my assessment there, a plug. Let's see. Let's get the profile of plug. Let me get some company profiles here. So just looking at some of the fundamentals and other things that concern me, even though plug is a growth stock, something of concern is, and we talked about this on past shows. Look at this, Patrick.
Yes.
Look at the return on equity. It's a minus 7%, and a return on assets.
Yeah, keep in mind, like I said, the return on equity is based on income.
Right.
So not necessarily sales or cash flow.
So
it will generally, if it's got a loss or negative earnings or negative income, these ratios are going to be negative.
Exactly. And then here's the forward PE. So just looking at the price per earnings in the future.
Yes.
It's a minus 10. So just kind of forward is still projected negative. But good profit margin percentage is 600%. So early stage company, if one wanted to speculate, one could speculate and go for a company like this, even though it has a good rating from Barron's. So I just kind of want to throw that out there, Patrick.
Yeah, I'm looking at the gross profit margin. I was looking at that, and then looking at the net profit margin. It looks like it's got some fixed costs that it will have to overcome in the long run to be profitable. But I mean, the gross profit looked really good, and if they can maintain that means it has pricing power.
Yeah, good point. Very, very good point. And Tony
that means
Johnson
it has pricing power.
Just put a comment. He says, "I see the auto industry going with battery technology over hydrogen right now." So I mean, yeah, I think there are more EV, electronic vehicle plays on the batteries versus hydrogen. I would tend to agree with you. That would be another bearish case to say that even though Barron's had that pretty impressive article, one may want to reconsider on plug and for the other reasons that I put in place. So Patrick, I know you were going to show the case on Nvidia. We beat the Nvidia mantra like crazy. So why don't you go ahead and share with the audience what you have on Nvidia?
Certainly. So Nvidia has done really well in the last month. I just want to share my screen real quick. And it's pretty much up by 23%. So if you bought in at around roughly, I think it was about 600 or so, a little bit above $600 a share at the beginning of last month. This right now is, let me see. Am I sharing my screen? Give me 1 second.
It's coming up, Mr. Patrick.
Okay. Give me 1 second. I'll just pull up the chart real quick. All right. Can you see this?
Yes, Patrick. I would.
Okay, good.
Yeah, I see the chart. Can we go into the article first, if that's okay?
Yeah, we could go into the article.
Yeah, let's go into the article first on Nvidia before we show the charts on Nvidia. I want the audience to kind of see what the experts are saying about this company that we keep talking about.
Okay, so can everybody see this?
Yes, we can see it, sir.
Great. So here is an article on Motley Fool, which is a widely followed board. And they were analyzing why is the stock up 23% for the month of June. And one of the main reasons is, or is that they have, Nvidia that is, has a pending, very strategic merger with ARM's Holdings. And in a previous discussion, I suggested that ARM's Holdings will allow Nvidia to go into further go into 5G and go into handsets and compute and tablet computers versus just data centers and desktop computers and mainframes. So it gained 23% last June because the ARM Holdings deal is being supported by others in the semiconductor space. Broadcom, Marvell Technology, MediaTek are all very important players in the space. Now, if these companies thought that Nvidia was going to have a grossly unfair advantage, then they wouldn't back this deal. However, they've come together and they said, okay, this thing looks really good to us. I think it's not going to put us at a very bad advantage. We support the deal. And what this will do is it will accelerate Nvidia in going into the bringing its AI technology into the 5G networks, and it will help build out the 5G networks as it augments over time. But not even so much that. Nvidia already has a strong presence in its current market. It's very, very high growth in gaming, data centers, and the EV space without the ARM deal. So even if the ARM deal were not to go through, Nvidia will still do exceedingly well over a longer period of time. But of course, the ARM deal is just icing on the cake.
Yeah, and that ARM deal was not a guarantee, and a lot out in the I guess in the market, a lot of the analysts and out in the whole chip space thought that there would be more pushback on this whole deal with ARM, because ARM really controls a lot of the cell phone market and tablet market because of the architectural licensing, proprietary licensing, architectural licenses and designs that they have. So the fact that the whole community got behind Nvidia and said it was okay, they weren't threatened by this deal, they supported the deal, that was huge. Yes. That was huge. Nvidia is going to kill the game once this deal goes through. But go ahead, Patrick.
Which is expected to close like I think the first or second quarter of 2022. So not even a year from now.
So, just getting ahead of that. So again, let's reiterate the bullish cases on Nvidia. This ARM's holding deal is a game changer, because once Nvidia owns ARM's holdings, it's a wrap. Because they already have a good segment, the graphics side locked down. I know AMD is a big competitor. But then on top of that 4-for-1 stock split is also providing a lot of momentum as well.
It is. But not only that, Nvidia is very strong in AI in its current space. It's getting into the EV market,
Oh yeah,
providing
that's I
AI
forgot about
technology
that.
in in um, in the EV space and other autos, and it it made an acquisition of a mapping company that will further facilitate Nvidia's foray into the EV space, providing its AI technology to that. And Nvidia is one of the leading AI companies in the world
So
with its strong data center.
let's let's look at the charts then, Patrick, because I previously interrupted you before,
Okay,
and so go right ahead. I know how much you love the charts.
so right here in this area, it was in a consolidation pattern. So around, let's say, let me pull this down. So this is about June here, and it's around 650 a share. So this is about June here. But then it kept pushing higher and higher because of the excitement of the takeover of this mapping company for Nvidia's foray into the EV space, or further foray into the EV space with its AI technology. Of course, the excitement over the four for one stock split, and then of course the recent spurt right here, where it broke from around 775 to 819, where it is right now, or 18. It's just that's been accelerated by the ARM deal. But I mean, it's a stock that's just been on fire and will continue to go strong. More importantly, though, there have been a number of analysts who have come out and say that this company will could go as high as $1,000 a share. I think I talked about this last week. There was a guy from Piper Jaffray's in St. Louis, very influential analyst, who said that the company was going to company stock should hit 859. Another analyst came, and I think it was Bank of America Securities, came out and they said it was going to, they raised the target from 800 to 900 a share. And I think BMO came out, Bank of Montreal, came out and they said that stock was going to go to as high as $1,000 a share. So that's why the Nvidia has just been on a tear.
Yeah, and Patrick, when we were looking at some of the numbers we saw before on return on assets, return on equity, should we show those numbers again so that the audience can
For
see?
Nvidia, yeah.
Yeah, so they can see why. I mean, I look at a plug. Plug is losing money. It's projected. It's a spec, right? It's a speculation stock where you can risk and get some upside. But why, when you have companies like Nvidia with excellent execution, excellent leader, incredible proprietary technology, and acquisitions like Arms Holdings, that it's just going to build a moat around the business, and so it's just an easy play. Now, should you get into Nvidia right now? Nvidia has run too much, so you need Nvidia to pull it back down. When you look at the Bollinger
Agreed.
Band, you need Nvidia to pull it back down to at least the middle, to the
Mm-hmm.
middle line, which is the 20-day moving average, which a stock typically trades around. So you cannot buy Nvidia at these levels. But once it pulls back, that's why we keep harping on Nvidia, because once it pulls back, you have to be prepared to jump in and buy. So,
Okay, so let me share my screen.
all right, go ahead, Patrick.
All right.
And I feel like we talk about Nvidia weekly, but I think it, you know, I would feel remiss to just make a plug on plug without showing the fundamental analysis side, and then without comparing it to a company like Nvidia where you're going to make money.
So here are the here are the numbers.
Now look at that. Look at that. Blow that up, Patrick. Please blow that up. The Nvidia ratios right there. Look at that return on equity. Look at that return on assets.
Look at that, the net profit, the profit margin and the net profit margin. I mean, it's just making money all over the place.
Good gracious. And the PE, the price of earnings compared to forward earnings, is only 40.
Right? 40. And then the price earnings to growth for a tech stock is actually pretty good. I mean, that's competitive.
So, I mean, we're about.
And then you look at the stock market beta.
Yeah, that's a good.
And it's still only
1.3.
And that's actually not that bad.
So Patrick, let's talk about beta a little bit and what that beta means, because that beta talks about the volatility of a stock compared to the benchmark. And the higher that beta number is, the more of a stomach churn you would have because the price swings. So will you talk about that a little bit?
Okay, so essentially the benchmark is the S&P 500. And slower growth mature companies will generally have a lower beta. They may have a beta of about maybe 0.5, 0.6, 0.7. Some of the higher growth tech stocks will have betas maybe like 2-3 times. Nvidia has a beta of about 1.38, which is really good. Very competitive. That means, yes, it's going to swing with the market, but it's not going to have the ridiculous highs and lows as some of these other tech companies may. So I think, even if you do buy that around here, if should the market come back, it may not come back that much. But then what you might want to do is don't buy it all at once. Dollar cost average.
Correct. Yeah, not buy it all at once. Let a pullback happens and we shall be good to go. So Patrick, I mean, that's kind of what we wanted to share on the 4th of July.
Yes.
Still kind of beating the drum on some of the same stocks. I know we have some things planned in the future. Some, kind of tutorial type things. I want to talk about some execution related items when it comes to the market, like the bid and ask price and market makers and stuff. So that's still on my mind to share. Before we wrap it up, what would you like to share before we wrap it up, Mr. Doherty?
Okay, so I want to talk about the SPX and the credit spreads thereof.
Yeah, the trades that we talked about last week from Las Vegas, the money that we made, and also the postings that I posted earlier this week. We made some money on those trades. So let's talk about that a little bit before we wrap it up.
Okay, so the SPX has options that expire Monday, Wednesday, and Friday. And those are the times that I like to put on something called a zero DTE, meaning 0 days to expiry. So it's essentially a day trade. And this is what I've been doing on the SPX, which is the S&P 500 index. Good thing about the S&P 500 index, right or wrong, there's no assignment of an underlying. It's a cash settlement between your, for the amount of the gain or the loss that you would incur. And I like to place the trades after all of the economic news has been factored into the market. And then I usually like to place the trade on the top end of the Bollinger Band towards the end of the day. And I like to usually go maybe 10, 15 delta, which essentially means about 85 to 90% probability of finishing out of the money. This is a strategy that has worked for me over the last couple of weeks. I place a trade usually the last hour of trading to let it expire worthless. And it's a credit spread of maybe 5 S&P 500 points. And I've been able to collect, $500 a trade.
That's pretty exciting, pretty good stuff, Patrick. I know.
And I'm 4 for 4.
Yeah, I know you're 4 for 4. You tried to do my NDX, so you did SPX, and I did the SPX. I made some money. I made like $700, and then I did the NDX, which is the Nasdaq 100, and I made about $1,300 in a day. So I made $2,000 over a 2 trading day session, which is pretty cool. I tried to put on the NDX trade on Wednesday and also on Friday, because these market trades, these indices trades, they're only available on, like what you just said, Mondays, Wednesdays, and Fridays on that's when they expire. So you put on the trade the day that it expires, and unlike regular stocks, which expires once a week, indices give you an opportunity 3 times a week to do 0-day trades, like same day trades. So anyway, I know the NDX trade went against you. You actually lost on my trade, but your trade with the SPX, you won. So good for you.
Yes. And I didn't lose all that much money on the NDX.
Yeah. But
I know that's not my market.
Yeah, and that's the point I'm trying to make. There's a market for each person. So what may work for me may not work for you, and vice versa. And you just have to stick with what you're comfortable with. Some people are more comfortable. The NDX is in the $14,000 a share range, and you're doing spreads on it. Versus what's the SPX range, right? $4,000 range doing spreads.
It's about 4,000 to like 4,355, roughly.
So we're talking about a magnitude higher and more risk, but more money, but more of a risk tolerance. But certainly we have strategies using the Bollinger Band. It's the same strategy for both, so they both work. So it just depends. But I think that's it, Patrick. It's the 4th of July. Happy 4th of July to everyone out there. Thank you, everyone, for the support. And we're going to wrap it up here. Like always, we call this show the Bet Out of Debt Show. And when you place a trade, it's called placing a bet. And hopefully it's a winning one to keep you out of debt. And like always, keep investing. And we will see you next week. Take care and goodbye.